Welcome back, guys and gals. You're listening to the Northern Miner Podcast, and I am your host, Matthew Keevil. As always, we are brought to you by the Yukon Mining Alliance. Please surf by yukonminingalliance.ca and check out all the exciting exploration and development activity going on in Canada's Yukon territory. And welcome to 2017. Another year in the rear view. I hope everybody had a fantastic holiday season with family and friends. Maybe popped a few corks, took some time off, hit the slopes. We have been on the west coast anyway, peppered with snow. The local mountains have been very nice, though very cold. Very cold weather. You got to watch out for that global warming. It's getting real hot out there. But yeah, we are looking at a new year and some new realities, both financial and political, that we're going to be tackling. I have some interesting bank reports and financial institution reports that sort of take a forward-looking predictive stance on 2017. And so we'll look at a little bit of maybe what we can expect, where we can see investment dollars, where some of the major economies might be going, and what some of the analysts think about, Canada versus the US, what's going on in Europe, how China's looking in terms of manufacturing and things like that. So we'll be tackling that. This will be a bit of an abridged episode because we aren't fully back in the swing of things in the studio, but next week we will have your regularly scheduled programming. Leslie will be back in studio with the Geology Corner, and we'll see if we can get some more exclusive interviews with mining executives and analysts. But for now, you got me this week, and we're going to be taking a look at a couple reports from some of the major banks, namely BMO and Scotiabank, on China, on the US, on Canada, and maybe a few of the stock picks that they mention as their favorites moving into 2017. Now, of course, one of the major themes we'll be looking at this year is the incoming Donald J. Trump presidency in the United States. And those who've had their ear to the ground on the newswire over the holiday season will have already seen a little bit of a sneak preview of how this might play out in the United States. Firstly, we don't know a lot. There is some uncertainty in terms of policies on protectionism, how NATO's going to go, his approach to defense and things like that. What we have seen already is that A, he's probably not going to stop using Twitter, and B, he's not afraid to use Twitter to call out specific companies and attempt to influence corporate policy. Now, what we saw over the holiday season was a tweet directed at Ford Motors, and the response was that Ford actually pulled expansion plans for a large-scale Mexican plant. And Trump has also levied similar statements towards Toyota and some other auto manufacturers in terms of his general distaste with outsourcing means of production from the U.S. And he's still talking about generating tons of jobs. We saw the pre-New Year, I should say, spike in uranium prices following Trump sort of lauding the potential for uranium and nuclear power. We've seen stocks like NextGen, which has jumped significantly up to about $2.85 per share at the time of recording. Cameco has bounced back based on those statements. So Trump has proven that A, he's not afraid to use social media to bypass traditional legacy media institutions, which he used to great success during the election, and B, he is very much not afraid to go directly at major corporations and attempt to influence their plans in terms of expansion and production centers. And of course, we have to look into how that may impact Canada. And there has already been a lot of news copy and columns written on the potential impact of the divergent viewpoints of the Trudeau administration vis-a-vis the Trump administration, and how things like carbon taxes might impact competition, how that might impact capital inflows and outflows, and maybe draw more investment towards the United States, putting Canada at a bit of a disadvantage, especially in terms of fossil fuels. And that segues pretty well into our first sort of analyst note looking forward into 2017. BMO put out what it is calling Best of BMO, the Canadian edition. And this is a broad-scale capital equity report that they put out in early January, and it covers everything from materials, so our mining sector, through energy and oils, energy infrastructure, diversified financials, and banks. So what we have here is sort of a broad sweeping outlook on what the year might look like for mostly focused on the U.S. and Canadian economies. Now, interesting, what they said is after another mildly disappointing year of global growth in 2016, BMO expects a modest pickup in the coming year. And when they say modest, they say overall they'll be looking for global GDP to perk up slightly to 3.1%, quote unquote, from the post-recession low of 2.8% in 2016. For Canada, the potential combination of firmer U.S. growth and the moderate recovery in commodity prices sets a positive backdrop for the coming year. After 2 years of struggling with roughly 1% growth, BMO has bumped up its 2017 GDP outlook for Canada to 1.9%. And beyond a better external backdrop, domestic growth will find some support from a rollout of long-awaited infrastructure outlays that we're familiar with from the Trudeau administration. However, BMO does caution it expects that the economy's main growth engine of the past 2 years, the housing sector, will lose momentum this year, partly owing to tighter mortgage insurance rules. And then they say, though, on the flip side, the economy's biggest drag of the past 2 years, business investment, is projected to turn higher after a combined plunge of more than 18% over the past 2 years. And so this will play out quite interestingly. I mean, in terms of one of the other things we'll be looking at very closely is the performance of the TSX. And what BMO says in terms of the TSX, they believe that Canadian stocks will take a backseat this year to the U.S. once again. Brian Belsky, the chief investment strategist at BMO, is looking for the TSX to hit 16,000 by year end, which would be up about 4.6%. And they do note, as we mentioned earlier, the potential policy shift in the U.S., which should be significant moving from the Obama to Trump administration in terms of things like taxation and environmental protectionism. And so what the BMO has concluded is that a broad policy shift in the U.S., especially relative to Canada, and when they're talking about less regulation and renewed fiscal stimulus, will likely see asset flows swing back to the U.S. at some point during the year. And once again, they also say that the Bank of Canada will likely remain on the sidelines this year. That will keep Canadian short-term bonds pinned down through at least the first half of the year. Decent growth through the middle of the year, an accelerating U.S. economy, a tightening Fed, and rising U.S. Treasury yields will combine to push government and Canada yields higher right across the curve as well. So that's a little bit of discussion on sort of the interaction between the potential changes in the U.S. economy and Canada. The materials, the sort of, I guess, preferred stocks, let's say, for in our BMO report that we're looking at here. This is just focusing specifically on materials. So we have some royalty companies, but mostly miners. Detour Gold, Ivanhoe Mines, Newmont Mining, Osisko Mining, Royal Gold, and Semifo are the sort of preferred materials gold producers for BMO in our report. Meanwhile, we also have a report from Scotiabank on the China commodity strategy. And I always find these interesting because they tend to get into a little bit of the narrative coming out of central Chinese government on how they feel about the year ahead, and also what they'll sort of be doing in terms of themes for fiscal and monetary policy, which, as we all know, can have a very broad impact on our industry. You just have to look at the thermal and metallurgical coal prices during the last half of the year to see how fundamental the Chinese strategy can impact, especially industrial commodities. So this one's a December Purchasing Managers Index review coming out of China. The official manufacturing PMI for December came in at 51.4. That's slightly shy of the street's estimate of 51.5. And Scotiabank says it believes this positive momentum will be carried forward into the new year. China's recent policy messages have been focused on maintaining stability in 2017, as opposed to bolstering growth through additional stimulus. So Scotiabank notes that President Xi recently remarked that China doesn't need to meet the 6.5% GDP growth objective if doing so creates too much risk. So this seems to indicate Beijing's willingness to forego growth for stability, and potentially foreshadows China's eventual deviation from the 6.5% growth target. With the prospect of greater stimulus measures becoming increasingly unlikely, Scotiabank believes upside in the PMI may be limited. So an interesting thing to see, just looking a little bit closer at that purchasing managers index data, and just for those who aren't economists, this is typically an indicator of the economic health of the manufacturing sector, which is of course something we look at in terms of the Chinese economy in a major way. So looking at that underlying data a little bit closer, the December level of 51.4 declined slightly from 51.7 in November, based on falling output levels during the month. Severe smog in northern China has led regulators to close down steel mills and factories in efforts to improve air quality. Other than environmental concerns, Scotiabank says production will likely see further slowdown next month ahead of the Chinese New Year celebration. And Chinese policymakers held the annual Central Economic Work Conference, CEW, in late December, which essentially maps out their plans for 2017. And based on the press release, the Chinese government will and just to clarify, this is Scotiabank's reading on the press release and not the Northern Miners or my own. One, focus on maintaining stability in the new year, as mentioned. Two, extend fiscal support for infrastructure investment. Three, continue to advance supply side reform. And four, tighten monetary policy due concerns of asset bubble risk. So it's just some interesting stuff. Obviously, one of the things China's been very protective of over the, let's say, the past decade has been that growth figure, that GDP growth figure, and they've pretty much bent over backwards at every opportunity to maintain that target or to meet those targets that they set. So the fact that they're sort of leaning away from that 6.5% figure and saying, well, we have this figure, but if it creates too much risk for the economy, we're willing to downgrade that target, is an interesting sort of, not necessarily major change in theme for them, but it is something to watch moving forward. And as mentioned, the Chinese policy towards coal, where they cut down the days allowed for coal production and then ramped it back up over the last 6 months of 2016, is interesting because we saw how much of a fundamental impact that can have on seaborne coal prices, both thermal and met. And we've also seen iron ore bounce back a little bit based on that as well. Just some improved manufacturing data coming out of China. So it's generally quite an interesting little read. And we'll be watching that moving forward. So that's sort of the three, talking about the Canadian-U.S. economic dynamic and the Chinese dynamic. It's an interesting looking forward as far as what we might see from, let's say, copper, which has been sort of frozen around that $2.50 per pound mark over the last almost 6 months now, and then also in terms of commodities like gold, which is inherently tied to the volatility of global markets, and we haven't seen too much volatility lately. Now, with that being said, as we mentioned, with Trump coming in, who knows what might happen. But as far as economic fundamentals, most of the reports coming out recently have largely been fairly positive. And as we noticed with the PMI in China, and also a rather rosy Canadian job report over the last 2 weeks. So an interesting times definitely for material investors. And I've heard a little bit of buzz around the industry in terms of copper being something people are starting to look at a lot more closely, especially in relation to what we've talked about as maybe a bit of an oversupply dynamic and what the actuality of that is in terms of stockpiles and what people have in the LSE and things like that. So it'll be interesting to see moving forward. These are just some themes to keep your eyes on as we look forward heading into 2017. One of the other things Scotiabank mentioned is they're still quite bullish on tech due to the metallurgical coal prices fundamentals that they're seeing. So it's quite interesting. Scotia Mining Sales thinks it's time to buy tech. So it's just interesting to see sort of the shift. I mean, if you'd rewound roughly 12 months, I think the probability of getting a buy recommendation based on met coal would have been pretty much zero. And also, if we rewind a little bit when copper was nearing that $2 per pound mark, there was just not a lot of interest in the commodity. And at the same time, we saw gold surging up to around that $14 plus $100 per ounce mark. Wow, have things changed. So just sort of interesting to see how sort of the fundamentals can be, even the long-term to mid-term fundamentals where we look at things on a 2-year plus basis are apt to change over a monthly period. And it's just an interesting thing to be cognizant of, because you've heard some investment professionals being exceptionally bullish on gold 6 months ago and are now sort of shifting their attention to look at base metals and take a much closer look in terms of investment thesis on what might be the best entry point. Are we looking at it now? Will they go up? Will they go down? So it's interesting as far as that goes, just to keep our eye on those investment prospects. And moving right along. We would be remiss if we did not have a little bit of junior/explorer news heading into 2017, because we do love our small caps and exploration guys and gals over at the Northern Miner. And I do have a little bit of news coming from an interview I actually conducted this morning. People may have or may be familiar with a company called Cordoba Minerals, which is advancing its San Matias copper gold project around 200 kilometers due north of Medellin, Colombia. And this is an interesting one. It probably, if anything, buzzed on people's radar because Cordoba's joint venture partner is High Power Exploration, HPX, which is a private exploration company that's indirectly controlled by Robert Friedland. So there's a big sort of entrepreneurial name for everybody to sort of latch onto. So it's been a company that's definitely, I've heard mentioned numerous times. Joe Mazumdar and Brent Cook of Exploration Insights have mentioned it to me. Mickey Fulp, the mercenary geologist, has mentioned it to me. And it's covered, I believe, Haywood's doing a little bit of coverage on it as well. So it's a company that's caught people's attention, and they have hit some pretty interesting grades. I mean, a high-grade copper. So what they did is they actually put out a maiden resource on January 5th. This is for their Alacran deposit, copper-gold deposit, which is on the San Matias property. So the initial pit constraint inferred mineral resource for Alacran is 53.52 million tons at 0.7% copper and 0.37% gold. That equates to around 0.9% copper equivalent. That also includes a higher grade sort of subsection, if you will, of 17.37 million tons at 2.14% copper and 0.41 gram gold. That's above a 1% copper cutoff. So an interesting looking deposit. In terms of grade especially, you don't see those grades too much, especially in terms of the potential. I don't want to say large-scale discovery, the potential for a large-scale discovery. Cordoba does have one of those land positions where, if people recall our pre-holiday special with Joe Mazumdar from Exploration Insights, he got into how majors are very interested in district-scale potential large land positions with the prospect of making multiple discoveries that could lead to a district-scale opportunity. And Cordoba certainly has that in terms of where they are in Colombia. They're at sea level, really close to infrastructure, well set up. And this resource actually starts from surface, so their strip ratio should be relatively low. Obviously, we won't know that until they get into engineering. But I had an opportunity to get President and CEO Mario Stifano on the phone to talk about the resource. And one of the things we had to talk about was they put this resource out on January 5th, and their stock subsequently went down around 15 cents or nearly 18%. So it seemed like the market wasn't overly enthused about it. So one of the things I asked Mario was, well, what's the strategy behind putting out a resource, I believe, that incorporates around 30,000 meters of drilling? So for a deposit of this potential magnitude, if you're drilling for copper porphyries or replacement associated copper, obviously, as we all know, anyone who listens to this podcast, I assume it takes a lot of drilling to outline something, with any sort of size or economic impact as far as maybe attracting a major or some sort of large-scale institutional investment. So I talked to Mario and I said, well, what was this sort of, they haven't really put out drill results from their previous season yet, so what sort of was the strategy behind putting out this resource at such, a relatively early stage for this sort of copper gold deposit? And he said, well, one of the things that they're trying to do is they want to get, it's really difficult to attract institutional investment to your project without in situ resources, because they just need, he's like, they really need something to model. So they want to look at it and be able to sort of plug the numbers into their models and get a better idea of, valuation and things like that. It's easier for them to justify. And he said the other thing that they wanted to do was that HPX recently agreed to move into the third stage of their earn-in. And and that is involved taking San Matias all the way to a feasibility study. And now Mario said that they're at least 3 years away worth of drilling before even the Alacran deposit, which is the one they have the resource on, is ready for feasibility. But he said that HPX is very much involved in not so much focusing on this one specific target, but they see the large district scale potential, and they want to continue to do a lot of more blue sky exploration, looking at some targets that have been generated by geophysics and things like that. And as we mentioned, Alacran is more of a replacement associated deposit. They're also looking for porphyry style mineralization on other sections of the property, and they haven't had too much come out in terms of news yet on the drill results from last year, as I mentioned. But we do expect in the next couple of weeks, Cordoba will start to release some of the drill results that they had accumulated over the last year. And Mario said they ended up drilling about 13,000 meters. He also sort of sneak peeked me that their budget for this year is looking like it's going to be about $6 million, their exploration budget. So Cordoba should be spending a good amount of cash trying to get, well, actually it'll be obviously High Power will be funding it, and working with the company to work on the targets and sort of the drilling. But they will be quite active down at San Matias this year. And it will be interesting to see sort of where they go in terms of which targets they prioritize. I know they will be looking at sort of an eastern extension on the Alacran deposit, which is where they have the resource now. So it was an interesting conversation. It was just interesting to talk to him because the market didn't exactly react that well. Now, given Cordoba is back up to around 78 cents at the time of recording, they were up at about 85 prior to the resource release. So it was just a little bit of an interesting response from the market, who I think I get the impression talking to some people on the outside that people were really a lot more interested in looking at their like they want to see the drill results from this past season, and people are really sort of maybe waiting a little bit to see how the drilling went last year. But one of the things Mario said is they're not really too focused on quarter by quarter stock prices. They're more interested in the long game. And having a partner like Friedland, who is earning his way up to over 50% of the project, means that they have a significant access to capital already. So he said you probably shouldn't expect a financing for Cordoba in the future, and that they really only need money around to cover things like G&A and sort of the actual nuts and bolts of running the company. So it's an interesting deal, and I do hear quite a bit about it. It'll definitely be worth paying attention to, because let's be honest, you don't see outside of some specific deposits like Nevsun's Timok deposit in Serbia, or Timok, sorry, copper equivalent grades up around that 1% level, and especially in jurisdictions that might be more conducive to permitting and social license and things like that. And Cordoba's made a large effort to communicate to the market that they are in a mining friendly jurisdiction in Colombia. If actually, interestingly enough, if you're interested in more coverage on Colombia, our editor-in-chief John Cumming was actually down there late last year, and has a bunch of interesting material coming out. I'm not too sure exactly when, but it will be coming out this year, sort of on his impressions of some of the things going on down in Colombia. And it's interesting because the things that I've gathered about Colombia in terms of mining jurisdiction, this is obviously third-party information during discussions generally over beer, but that it's very modular, and it's highly dependent on where in the country you are, and certain areas are much more difficult to achieve social license than others. And one of the things Mario said is that they're in a very mining-friendly jurisdiction. There's artisanal mining there, and they have very good relationships with the local communities. And based on the fact that they drilled 10,000 meters last year, you'd have to think that they are not having too much trouble getting their drill permits and getting things moving at a fairly good pace. And then they also obviously, as mentioned, intend to do around $6 million in work this year. So interesting company. Great interview with Mario. I'd like to thank him again for getting on the phone with me. There'll be an article probably on them later this week, I believe, just pending my workflow generally. So keep an eye out for that. And while we're on the copper, and I was talking about intercepts, we mentioned Timok. One of the other things we're doing is that's really cool. I'm a big fan of this. John, our editor, started this. We're charting sort of month by month, or we're splitting up the years, whether it be quarters or whatever. But we're tracking drill intercepts, and we're tracking sort of the top 5 best width times grade is how we're measuring it. Drill intercepts, and John did the top 5 gold intercepts, and I recently did the top 5 copper intercepts. And it's really an interesting exercise because you get to, especially in terms of copper, because there's not a lot of really exciting greenfield going on right now. And obviously, Nevsun's work in Serbia alongside joint venture partner Freeport in the Timok magmatic complex is almost second to none. Similarly with, if you look at Friedland's Ivanhoe mines, Kamoa and Kakula deposits in the DRC, those are kicking up some grades, I'll tell you. But outside of that, I mean, some of the top ranking copper intervals, one of the more surprising ones for me was Arico Metals at the past producing Comes site up in northern BC, and people remember Comes South and Northgate, but they've been drilling their Comes East target, and one of the top intervals was actually coming out of BC, and that is something I would not have expected. Typically you would expect a really promising copper gold porphyry or copper mineralization interval to come out of not necessarily a developed mining jurisdiction, let's say maybe the DRC or Colombia. That, yes, I could totally see that, but coming out of BC, that's sort of surprising to me. So it's an interesting exercise that we'll be doing going forward. Keep an eye on those, and if you have a subscription, please surf by and check out the top intercept articles. Those are produced in conjunction with our sister company InfoMine. They have a service called Intelligence Mine, which has actually quite a wealth of data on it. So you can always go and check that out as well. They help us track the journal intercepts to have really good financial data and stuff like that. So it's a cool emerging tool that we're going to be using more moving forward. And if you don't have a subscription, please think about subscribing. We are moving ahead with a bunch of new initiatives, including video. The podcast is going to keep rolling. We're doing a bit more data journalism in terms of tracking things like intercepts. We'll be looking at financings a bit more closely. So please do consider picking up a subscription. It's an absolute screaming bargain. So you can surf by our website and hit the old subscribe button there, and that would do us a great service. And also, please do like us on Facebook and follow us on Twitter, and check out our YouTube as well, because that's getting going. So we are turning the wheels of the social media machine. But yeah, so that pretty much wraps it up. As mentioned, this is going to be sort of a smaller episode with just Matt, but next week we will be getting you back to your regularly scheduled programming. So thank you again for joining us at the Northern Miner Podcast. It is always a pleasure, and we will catch you next week.